Hi everybody, this is Mike Deschamps, your instructor for Accounting 145. And what I want to do this morning is take the opportunity to really take a deep dive into depreciation. Now, as you look at your screen, you can see that I have one of the PowerPoint slides up here. And I'm going to use the PowerPoint slides as part of the basis of this narration as I talk about one of the key concepts under Chapter 6, which is depreciation. And let me just say this as before we even begin talking about this. Depreciation is a very difficult concept. It is not a concept that you automatically get it the first, second, or maybe even the third time that you read through it. It takes practice working with depreciation to really get it. So don't be discouraged. You'll get pieces of this as we go along. You'll get better with it. But again, the key to really understanding depreciation is to do more of it. And of course, for those of you taking this class, you're going to be dealing with depreciation because you have some of that on tax project number 1. And for those of you that go on to take the business entities class, Accounting 146, you'll see it again. And if you go on to take Accounting 147, which is the advanced issues in income taxation, I will talk about it there again. So depreciation, very important concept, but one that takes a little while to really grab your arms around. But you have to start somewhere, and that's what we're doing in this class. So in this chapter, the heading is Schedule C, which is self-employed business income. That is a form of business entities, but recognize that with any business entity, they're going to buy equipment. And in the course of buying this equipment, they're going to lay out money. And of course, to be able to recoup that cost, the way that we do that is through this thing that's called depreciation. And why that's important to us is that that's when we actually get it to write that off, if you will, against the income that I've earned. So it's a legitimate expense that I get to deduct that's going to lower my taxable income, which by effect lowers my tax due. All right, so we want to make sure that we're not missing out on the eligible depreciation that I'm allowed to take. Now, as we said, learning objective number 1, income and expenses of the self-employed. Self-employed income is reported on Schedule C. And what we're going to do is on the Schedule C, we're going to show the number for depreciation, but we're actually going to calculate that on another form, the form 4562, which we'll be seeing in a few moments, and then we bring it over to the Schedule C. All right, so let's just jump into depreciation right now. And the key thing that we need to know about depreciation is what is my basis in the asset? And as we can see here, a great many times, the asset purchased, the basis equals cost. Now, there are some other exceptions that we see right here, or not really exceptions, I just call them different circumstances. But for us right now, the key one is here, that when we buy an asset, our basis in the asset is going to be our cost. You'll notice in financial accounting, they often use the word cost. In tax accounting, we use basis. All right, so it is based upon that basis that we're going to figure out what is the allowable depreciation that I can take on that asset. Now, in relation to the second one right here, personal to business, which often happens, we're going to go into a lot more detail on that in Accounting 146 when we talk about transferring your personal assets into the business. But for right now, we're just going to focus right up here. So when we look at this, let's look at this example. It says, Shelley purchased a laptop computer for her personal use last year for $2,200. This year, she started her own business and transferred the computer to the business. The value of the computer at transfer was $1,300. What is Shelley's depreciable basis in her computer? Now, this is one of those exceptions, all right? We're not talking about the cost, but rather what is the value of the computer at the point that it was transferred? That is $1,300, which means that in terms of the business starting to take depreciation, it is this $1,300 that she's going to use. All right, and let me just go back a second to the second slide. It says Jackson purchased a van for $22,000 and used it 100% for business. Now, let's stop for a moment. In tax project number 2, you have a situation where the person has their own business and they're using a van. However, in that case, they're not using it 100% for business. So one of the things that we have to look at is what percentage did she use it for business, and that's going to be the allowable amount of expenses that she gets to deduct. So, also it goes in the current year, he deducted $4,400 in depreciation related to the van. What is his adjusted basis in the van at the end of the current year? $17,600. Now, where did we get that from? We took the amount of depreciation, all right, depreciation expense. We subtracted from the $22,000 of my basis, and this now gives me my adjusted basis in the asset, which going forward is $17,600. Now, different assets have different depreciation periods, and these are set by the IRS. So as you can see up here on the screen, we have basically two types of properties that we're dealing with. When we look at bullets 1, 2, and 3, we're dealing with what we call personalty, personal assets, all right? And then when we look at bullet number 4 and 5, we're dealing with real estate. So when it comes to depreciation, we break everything down into two categories. Is it personalty, which is evidenced by bullets 1 to 3, or is it real estate, which is bullets related to 4 and 5? All right. And then when we talk about realty or real estate, we're going to break that into two different categories. We have residential real estate, which is depreciated over 27.5 years, and non-residential real estate, which is going to be depreciated over 39 years. And you may ask, and it's a legitimate question, why do we have these different time periods? Because when you have residential real estate, you are in effect providing a benefit to society. You're providing a benefit for them to live. So if you own an apartment building, you are providing a benefit by giving housing to people. You're not giving to them, but you're renting it to them. All right. Therefore, we're going to allow you to depreciate that a little bit quicker, which means you get quicker cost recovery than when we talk about non-residential real estate, which is like if you had a factory or an office building. Well, that doesn't really have what we'll call a societal direct impact as much, and so you're going to have to depreciate that over a longer period of time. So it says over here, an auto used in trade or business would be depreciated over what period of time for MACRS tax purposes? Well, the answer is B, 5 years. And in the second one, it goes, an apartment complex would depreciated over what period of time for MACRS tax purposes? The answer is C, right? Why? Because that's residential real estate. Now, let's go back to these keywords over here, MACRS. That stands for Modified Accelerated Cost Recovery System, all right? And that simply is the way that we described depreciation for tax purposes. For many of you that may have taken a financial accounting class or a college accounting class, you looked at depreciation, and some of the concepts here are very similar, starting with basis equals cost, but the way that we describe the process is a little bit different. So you have financial depreciation, you have tax depreciation, and by the way, and this is kind of jumping ahead a little bit, but I like to sometimes throw in a more advanced concept, this results in a book to tax difference, meaning the financial records and the tax records are going to have different amounts for depreciation because of the way that we account for it in taxation. Learning objective number 3. A warehouse would be depreciated over what period of time for MACRS tax purposes? 39 years. Why? Non-residential real estate is depreciated over a longer period of time. All right. So when we talk about depreciation and the methods that we use under MACRS, we have 3 conventions: the half-year convention, the mid-quarter convention, the mid-month convention. Now, for our purposes in this class, we are going to pay a lot of attention to the half-year convention and a lot of attention to the mid-month convention. We're not really going to get into the mid-quarter convention. We're really going to focus on these two. Now, when we talk about the half-year convention, that is going to be used for personalty. What does that really mean? Depreciable assets that are not real estate is always going to fall into the category of personalty. All right. Now, what that means is with the half-year convention, no matter when we place the asset in use during the year, In the first year, we're simply going to take a half years of depreciation. All right. So whether it was put into service in January 1st or December 1st, in that first year, we're not going to take the actual, what we'd call the actual rateable depreciation based on when we purchased it. We're going to use this assumption half year, July 1st on. That's what we're taking as depreciation. Now, so in the year that we buy the asset, this personal T, we're only taking a half year's depreciation, which means that when we sell that asset or dispose of it, in the year that we get rid of it, we're going to make up that difference. So we're only going to take a half year on the disposal of the asset. This is where people get sometimes confused when you have a situation where the question asks you, well, what is the depreciation in the year of disposal? Well, when we're talking about personalty and we're using the half-year convention, which will always assume, unless we're told different, then it's going to be a half year in and a half year out. All right. Then we're going to talk about the mid-month convention. And the mid-month convention is used for real estate. Whether it's non-residential or residential, we're going to use the mid-month convention. Now, one important fact that I want to bring up here, that when we talk about real estate always sits on land, right? We haven't got to the point yet where we're suspending buildings in midair. All right, that's probably coming. It'll be a few years. All right. In that case, it's important to remember that we're not going to depreciate the land that the asset sits on. Land is not depreciable. All right. So if you tell me, Mike, I bought a building for $100,000 and the value of the land was $25,000, then the depreciable amount of the building is going to be the $75,000. So what we've done is subtract out the value of the land from the $100,000, $25,000, taking that out, so we're left with $75,000, which is going to be the depreciable asset amount of the building. All right, so land is never depreciable. If it's included in the cost, we have to back that out and then depreciate the rest. So when we're talking about real estate in the mid-month convention, no matter what month we buy the asset and put it into service, let's say I buy the asset in March. All right, and I buy it on March 1st. Well, we're just going to assume it was placed in service in the middle of the month, March 15th. All right, so we'll always do that. So at the end of the year, you know, I'm going to take X amount of months plus a half a month as the amount of depreciation. And just like we saw above with the half-year convention, that when I dispose of that real estate, I took a mid-month convention on the way in, and I will take a mid-month convention on the way out. All right. So let's say that I disposed of this asset on July 1st. Well, we're only going to take a half amount of depreciation for July. And so we'll end up with what? 5.5 months of depreciation instead of 6 months in the year of disposal. Let me skip these concept checks for right now. Oh, I want this one right here. All right. It says, to depreciate an apartment complex, a taxpayer should use the half-year convention. Why is it false? Because the half-year convention only relates to personalty. Any asset that we have in the business that's not real estate, machine, car, truck, tools, whatever, it's personalty. In that case, for the apartment complex, we would have to use the mid-month convention. Number 5. The taxpayer must use the same depreciation convention in the year of disposal as the convention was used in the year of acquisition. That is true. So I want you to think of it this way. I took a half year going in. I take a half year going out for personalty. With real estate, mid-month going in, mid-month going out. Now, when we talk about MACRS, Modified Accelerated Cost Recovery System, there are some differences underneath that banner of how quickly we can take that depreciation. And by the way, this will look somewhat similar to what we talked about if you've taken a financial accounting class, you know. And there we talked about, you know, accelerated cost recovery systems as well. All right. And we talked about double declining balance or 150 declining balance. And we talked about straight line. All right. Now, we don't really make that distinction as much going forward. We just simply know that that's happened. Now, for instance, when we look at personalty, usually we're using double declining balance, which means that we're taking more depreciation earlier in the asset's life, which that makes sense from an economic perspective because we know that assets are not as efficient in their earlier life as they are later. Give you a personal example. All right, so I have a car that's a 2009 Hyundai Santa Fe. All right, love that car. All right, but now that car is almost 11 years old, and I have to do more in terms of maintenance to make sure that that car stays running. Where when I bought that car new back in 2009, I didn't really have to do much of anything except change the oil and maybe change the tires every couple of years to make it run effectively. All right. So the thing about an accelerated method of depreciation, it more closely mirrors the economic viability of an asset. All right. And for those of you that have taken Professor Shafin for econ, he loves that because he loves accounting things to tie into economic explanations. And when they don't, he gets upset. But he's a great teacher. All right. And then we get down here to straight line. And straight line is the thing that Professor Shafin does not like because straight line does not model the economic efficiency of the asset, but we use it a lot because it makes it easier to calculate depreciation from year to year. And under MACRS, when we talk about the mid-month convention for either residential or non-residential real estate, when we look at the amount of years that we're talking about to depreciate the real estate, either 27.5 years for residential or 39 years for non-residential, basically we're using the straight line method. But we don't distinguish it as much, we just say it's MACRS. So look at this question. Shu purchased a piece of business equipment for $12,000 on May 3rd, 2019. The equipment is the only business asset Shu purchased during the year. What is Shu's depreciation expense related to the equipment? All right, so here's where I want to go into one of the ways to make doing depreciation calculations for you really easy. And so I'm going to back out a little bit and I'm going to go over here to your textbook. All right. And so you'll notice at the back of chapter 6, we have these appendices that relate to depreciation tables. Okay. And by using these tables, it's going to make your life really easier. So basically, in our study of this chapter, we're going to use two tables to help us figure out depreciation. The first one is this, table 6A-1 that in your book or in the online book is over on page 6-45. And this is the table that we're going to use for personalty, assuming that we're using the half-year convention. All right. And again, we're just going to assume that for right now. We're not going to get into the mid-quarter convention for personalty right now, just a half year. So you're going to notice several things about this table. All right. So over here in the left-hand column, I have the year. So basically, is it year 1 of the asset's life, year 2, year 3, year 4, and so on. And so you'll notice over here that if I'm talking about a 3-year asset, in the first year, I'm taking 33% of the cost of the asset and expensing it as depreciation, which means I have cost recovery. In the second year, 44%. So as a result of the first 2 years of an asset that has a 3-year life, I've taken almost 80% of the cost of the asset. So that relates to the fact that we're talking about modified accelerated cost recovery system. It is a faster way of capturing depreciation. In the third year, I'm only getting 14%, and in the fourth year, I'm getting 7%. Now, wait a minute, Mike. You just showed us up here that this is a 3-year asset. Why are we depreciating it over 4 years? And again, I'll go back to the point of it's the half-year convention. It's a half year going in, it's a half year going out, which means if we fully depreciate this asset, we'll do it over 4 years, even though in total it only equals 3 years. A half year, full year equals 3 years, but we've spread it out over 4 years. All right, that's a very key thing. And you'll notice we do the same thing with all of these other assets that we see over here. It says, again, she purchased a piece of equipment for $12,000 on May 3rd, 2019. This equipment is the only business asset Shu purchased during the year. What is Shu's depreciation expense related to the equipment? So the very first thing we look at is, number one, what's her basis in the asset? $12,000. That's what they told us. Number two, what is the useful life of this asset, or over what period is it normally depreciated? Well, because this is equipment, it will be 7 years. So I have the basis and I have the cost. Now what I'm going to do is I'm going to go over here to my table. And remember, we're talking about the very first year that she's owned it. So I'm going to take the $12,000 in cost. I'm going to multiply it times the 14.29%, and that's going to give me $1,714.80, which I am going to round up to $1,715. And as we go back to my problem, we can see that that is in fact the correct answer, 1,715. All right, so notice how easy that was, knowing two key pieces of information, or actually three. When did she purchase it? This year. What was the cost? $12,000. It's equipment, so it's personalty, so we're going to use the half-year convention, and we know that in terms of that we're going to take the percentage given on the chart in order to be able to do that. So I go over to my chart once again. First year, 7-year asset, take the basis, 12,000 times 14.29%, and after I round up, that gives me my $1,715, which shows me exactly how to grab my depreciation. All right. And so whenever we talk about personalty, we will always assume we're going to use this half-year convention, and whether it's a 3-year, 5-year, 7-year, 10-year, 15-year, 20-year asset, that is going to allow us to figure out the depreciation as long as I know what year we're talking about, what's the basis of the asset, and what is their depreciable life, which would be 3, 5, 7, 10, 15, 20. All right. Do is look at the second half of this transaction. It says if Shu sold the equipment on January 5th, 2021, what would be the depreciation expense for 2021? Excuse me. So one thing we want to bring up here is that, okay, so the asset is 3 years, 2019, 2020, 2021. When I jump over to my chart here, I'm going to go to year 3. And I am going to take the $12,000, the original basis in the asset. I'm not going to change that. I'm going to multiply it times 17.49. All right, 17.49%. Now, once I get that number, what I am then going to do is divide that number by 2. Why? Because in the year of disposal, we can only take a half year of depreciation. As such, when I divide that by 2, I'm going to end up with, as we see right here, $1,049.40. And since the 40 cents is less than 50 cents, less than half the dollar, we round down. That is the amount depreciation I took in the year of disposal. So remember that in the beginning, that half year is calculated in. When I dispose of it, I have to divide by 2 in order to be able to make that work. Okay, so I want to go back over here to our charts. And so whenever we're talking about personality, once again, we're going to use table 6A-1. And now I want to roll down here. Don't worry about any of these other tables. This is the one I want you to focus on, this very last one, table 6A-8. And this is going to be applicable to non-residential real estate. That is going to be 39 years. We're going to use the mid-month convention. And of course, the other table, we're going to use this one, and we're going to use this one down here. And both of those are going to get us where we need to be in terms of. So just a quick recap, we're always going to use table 6A-1, and this is going to be for personality, right? Then the next table that we're going to use is we're going to scroll down, never mind these other ones for right now, and we're going to go down here to table 6A-6 when we're talking about residential real estate, and then we will use 6A-8 at the bottom here when it relates to non-residential real estate. All right, so those are the ones that we're going to use. So I want to go back to our PowerPoint for a minute, and I want to bring up the next slide, which is Davis purchased an apartment complex on March 5th, 2019 for $330,000. What is Davis's depreciation expense related to the complex? All right, so let's break this down. Number one, do we know the basis in the asset? It's $330,000, and we're going to assume that the land has already been taken out of that. All right. When did he buy it? He bought it in March. Okay, March 5th to be exact. And what kind of real estate is this? It's residential real estate. All right, which means that I'm going to jump over here to my charts, and I'm going to go up here to table 6A-6, and I'm going to figure out what is the depreciation. All right, so this is year one. We know that it was produced or purchased in March. So we're going to take the cost of that asset times 0.2879. And when I do that math, it's going to come back and give us the correct answer of, for that first year depreciation on this asset, it's going to be $9,501. Now again, when we go back to the chart, remember the key pieces of information. What was the basis on the asset? The $330,000. What year are we dealing with? The first year, the year it was purchased. What month did we purchase it? In March. And therefore, we're going to use that percentage that's right here. Okay, so I'm going to stop the screen here in just about a second. So kind of recap what we've done. We've talked about using the MACRS depreciation system. We've talked about that there's some key pieces of information that I need to have. I need to have what is the cost of the asset, all right, what type of asset is, which is going to dictate the recovery period. And as we also said, we're going to break down our depreciable assets into two broad categories, personalty and real estate. With personalty, we will always assume the half-year convention unless they tell us otherwise. With real estate, we will always assume the mid-month convention. And under realty, we're always going to break it down into two broad categories. We're going to have residential and non-residential real estate. As we said, when we're talking about residential real estate, we're going to use table 6A-6. When we're talking about non-residential real estate, which is going to be depreciated over a longer period of time, we're going to use table 6A-8. And for personalty, where we said we're going to be using the half year convention, we're going to be using table 6A-1. That's it for now.